My name is Badryah Alhusaini. I am an assistant professor in the School of Accountancy at Carey School of Business. So in our paper, we are interested in private disclosure by firms and whether this helps reduces myopia by investors and, as a result, managers as well. And the whole idea there is that myopia is a result of investors having a lack of information. When they don't have a lot of information about the long-term prospects of the firm, they tend to focus on the short-term. And as a result, the managers tend to focus on the short-term as well to please those investors. So one way to reduce this is by disclosing more information to everyone. But this is problematic because some firms do not want to provide this information because their competitors can see it as well. So a solution to this is to provide more private disclosure. And this is how our paper started. The Jobs Act is a regulation that allowed this private disclosure. The Jobs Act allowed firms to meet privately with investors before the firm goes public. And as a result, managers were able to be more forthcoming about their prospects, their technologies, their strategies, etc. And as a result, investors became more comfortable with the firm and their long-term strategy. This allowed the investor to be less short-term oriented. And as a result, the manager became more comfortable focusing on the long-term and less concerned about these short-term blips. I think this research is important because up to this point, we have really just talked about selective disclosure and its costs. There hasn't been a lot about the benefits of selective disclosure. So what we're trying to do this in the study is say, look, we know there's these costs, but there's this huge benefit of reducing myopic tendencies by management and investors. And because corporate short-termism or myopia is quite widespread and could impede economic growth in the US, it's really important to also consider the benefits of selective disclosure.